So today we'll be looking at GPEC, which gives us exposure to private equity. Now, traditionally speaking, retail investors like myself and yourself as well, we can't get access to these sorts of investments, which makes this ETF super unique. If you guys are new here, my name is Faizy. This channel is about finance and investing. Before we begin, this video is not financial advice. I'm not telling you to buy this ETF. Do some research, let's jump into it. So GPEC basically stands for Van Eck Global Listed Private Equity ETF, and in summary, this ETF gives us a diversified exposure to 50 companies. These are the largest companies and the most liquid global listed private equity firms in the world. So this ETF is basically trying to replicate the LPX50 index. So jumping into some high-level information about the ETF, it is domiciled in Australia, which makes it quite easy when it comes to tax time. There is less paperwork since the ETF is not domiciled in the US, which is good for us. The units outstanding is 600,000 and the net assets are 11.5 million at the moment. But as time goes on, we should start to see the net assets increase over time as people start to buy up these ETFs even more, and so on and so on. Looking at the holdings, these are going to be 50 as we just spoke about just now. And the inception date is 23rd of November. So it's really only been a couple of weeks since the ETF has launched. Now, looking at the dividends, that is 1 dividend per year. Now, of course, this ETF is not a dividend-based ETF. It is targeting growth rather than income. So dividend is not the real focus of the ETF. It is mostly growth when it comes to price appreciation. Now, the actual underlying companies in the portfolio, these are growth companies. They're still trying to grow as fast as possible so that all the profits that they make, of course, they're not going to pay out those profits to their shareholders. They're going to use that money and they're going to essentially reinvest that money to keep on growing. And the other thing is, some of these companies in the portfolio may not even be profitable since they're trying to grow and reinvest as fast as possible. So that's why the dividend is only going to be once per year. The management fee is 0.65% per year, which is obviously on the pricier side. You will be paying around $65 per $10,000 invested. Of course, this is not cheap, especially if you compare it to a broad market ETF like IVV, VTS on the US side, or on the Australian side, you've got A200 or VAS. But just keep in mind that this ETF is targeting a very specific niche. Therefore, the actual cost is going to be on the higher side. In just a moment, we'll also have a look at the returns so you can see why this cost may be worth paying. Also, just keep in mind that this ETF is quite exclusive to the Australian market. This is actually the first Australian private equity ETF in our market. So of course, they are going to charge a decently higher fee. Now, you might be thinking, great, private equity sounds absolutely amazing, but just one question. What the hell is private equity in the first place? What does it mean? I always hear finance bros talking about it, but what does it actually mean? So let's talk about it. So basically, when you buy shares on the stock exchange like the ASX, those companies are all public companies. All the financials are there for all the investors to view. These companies have to report to investors every quarter, every half yearly with their results, and everything is pretty transparent. Those companies have an obligation to their investors to actually record their financials and actually present their financials publicly for everyone to see. Now, with private equity, as you can probably imagine, it is a bit opposite where all the financials are not there publicly and these companies are just private companies, as you can probably tell by the name, private equity. So of course, private equity is much less transparent to the average person like myself or yourself. And this ETF is giving you exposure to those sorts of companies, which makes it super unique in that aspect. So as a retail investor, why would you want to invest in companies like this in the first place? Firstly is the large capital outlays. Now, traditionally with private equity, you actually need lots of money to actually invest in companies like that. And retail investors traditionally obviously don't have that much money to lay down. Therefore, when it comes to investing in those sorts of opportunities, those opportunities are only reserved for people who actually have large amounts of money. Secondly is the long lockup time. Money is locked in for quite a long period of time, and traditionally you can't actually sell your investment very quickly. It's not as liquid as if you just bought the share on a normal stock exchange. This one is of course private, so you can't just sell immediately. And then thirdly, it is quite concentrated and illiquid, which obviously means you can't just sell it very quickly. Pretty much the same point as I said previously. And then lastly, it is quite risky, therefore it is reserved for those fund managers and high net worth individuals that get exclusive access to these sorts of opportunities because they're able to handle that sort of risk. Now, I just want to make it super clear the fact that just because an opportunity like this is very exclusive, that does not make it always good, right? Exclusivity doesn't always mean that it's something that it's good. There's a reason why these sorts of investments are reserved for wealthy people and wealthy companies, because they're able to handle risks like those, as opposed to retail investors. Yes, this is a unique opportunity, but of course it comes with lots of risk. And this sort of risk is clearly outlined in their PDS. As you can see, I found this for you guys on page 18, this 9.2.22, whatever this is. Pretty much what they're saying is investing in private equity companies has specific risk, and it actually talks about these companies having limited information. So there you go. Just keep that in mind. So all I'm saying is just be very mindful of investing in ETFs like this. Just because it's exclusive doesn't always mean that it's good. As you can see, they've got a massive line right here, and they're talking about pursuing evergreen opportunities. This flyer is basically a sales pitch for retail investors to actually get them to invest in funds like this. And they're talking about, if you read the little subscript, they're talking about potentially getting access to the next Google, eBay, or even Airbnb. Now this is possible, but it is quite unlikely. Just keep in mind that for Google to become as big as it is for just that one company, 50 other companies actually failed, so one Google could exist. So just keep that in mind. This space, although it is very lucrative, it does have lots of risk. So based on that, we want to make sure that we don't fall into what we call survivorship bias, where we just look at companies that succeeded like Google, Airbnb, and we completely ignore the companies that actually failed to make Google or Airbnb. So how this ETF functions is that it gives us exposure to private equity in 3 unique ways, starting off with the first one, which is directly. So this ETF invests in companies that invest in private companies from their own balance sheet. Secondly, we've got indirect private equity, where the ETF invests in private equity funds. And then lastly, we've got the private equity fund manager, where you're actually investing in the fund manager themselves. Looking at the returns for the ETF, today the ETF finished up at negative 0.4%. The 5-day return is almost negative 1%. And then the actual return from inception is negative 2.23%. Of course, we can't actually judge it based on that because it's only been a couple of weeks, as I said before, and as you guys can see. So let's actually look at the index directly and see what we can find. So in this table, as you guys can see, on the bottom row of each table, we can see the index, which is the LPX 50 index. And the last 6 months return has been 27% almost. 1-year return has been 70%, which is absolutely insane. And the 3-year and 5-year returns are 30 and 22%. Now, just keep in mind that these are annualized returns. So this is how much the ETF returned on average if you actually work out the compound rate of return, which is actually pretty insane if you look at it. This is definitely beating the market for the last 5 years or so. But as we said before, this ETF does have risk. I'm going to keep repeating this message so you guys get the memo. I don't want this video to be a sales pitch for this ETF. I want it to be like a balanced video where we look at the benefits and the risks as well. Now, you can actually buy this ETF completely brokerage free using a new broker called Pearler. This forms part of their free ETFs, where if you buy the ETF on their platform and you hold it for over a year, the actual buy brokerage will be completely free. You do have to pay a sell brokerage of $9.50 once you're selling, but when it comes to holding it, you'll be paying no brokerage. So the effective buy and sell brokerage is $9.50 divided by 2, which is about $4.75 each way, which is very, very cheap compared to other alternatives that are out there. This is a fully CHESS sponsored broker, and if you use the code right here, basically my first name, you can also get 2 free trades on top of the free trade you can get to buy this ETF, and I'll get a free trade as well. Link in description, go check it out if you're interested. Jumping into the holdings for the ETF, we can see 2 companies that are almost 10% of the overall weighting for the portfolio. We've got Blackstone and KKR. I'm not too sure about these holdings. I haven't researched them, but of course, they're specifically picked to target this private equity space. Looking at the country allocation, this leans quite heavily towards the US. As we see with many of these types of ETFs, it is over 50%. Then we have the UK and Sweden at about 18 and 10. Then we've also got some European countries and some Asian countries in there as well. Actually, only one Asian country, only Japan. And the sectors are highly related to capital markets at 87%, diversified financial services, and just cash there to make up the 100%. The market caps of the companies in this ETF are quite large, greater than 5 billion, and that's about 76% of the portfolio. Then you also have kind of mid to small companies making up the rest of the 25%. And then lastly, having a look at the portfolio composition, this is going to be 92% in stocks, 0 in bonds, and then other at 8%, and then some cash as well. Of course, there's going to be 0 bonds because this is a private equity ETF. It is not a bond ETF, therefore 92% is going to be in stocks. So this was the ETF. Personally, I'm not going to be investing in this because it's just not for me, but I'm keen to see what you guys think. It is quite a unique opportunity. The returns are there as we saw, but there is risk involved as well, as we also spoke about. But let me know what you guys think and if you would invest in an ETF like this. Now, if you enjoyed this video, check out my other video on the 5 best VanEck ETFs. VanEck is the ETF provider that's also listing GPEC and these other ETFs as well. So go check it out. And guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Check out my other video on